Every major recession in modern history has sent warning signals before it officially arrived. Think about the 2008 financial crisis, the 2001 dot-com crash, and the 1990 recession. The signs were there, but most people simply didn't know where to look. Today I'll reveal the 5 key economic indicators that professional economists and institutional investors monitor obsessively. These aren't magic tricks. No single indicator can predict the future perfectly. But together, they form a powerful early warning system that most retail investors and ordinary people have never heard of. By the end of this video, you'll know exactly where to check each indicator for free right now today. Let's dive in and learn how to spot trouble before it arrives. Understanding economic indicators is crucial for anyone who wants to stay ahead of financial downturns. These signals aren't just for Wall Street insiders, they're tools that anyone can use to make smarter decisions. By learning to read these signs, you can protect your investments, your job, and your financial future. The 5 indicators we'll cover today are widely respected and have a strong track record of predicting recession. Whether you're a seasoned investor or just starting out, knowing where to look and what to watch for can make all the difference. So let's start with the first and most famous indicator, the inverted yield curve. Inverted yield curve is probably the most famous recession predictor in all of economics, and for good reason. It has preceded every US recession since 1955 with only one false signal. Here how it works. Normally, if you lend money for 10 years, you expect a higher interest rate than if you lend for 2 years. More time means more risk, so the yield curve, which shows interest rates across different time horizons, slopes upward. Short-term rates are low, long-term rates are higher. But when the yield curve inverts, that relationship flips. 2-year government bonds yield more than 10-year bonds. This happens when investors are so worried about the near-term future that they rush into long-term bonds, driving their yields down below short-term ones. It's essentially the bond market saying, things are going to get bad soon and rates will have to come down. Visualize this. Imagine 2 charts side by side. On the left, you see a normal yield curve. It slopes upward, showing that long-term bonds pay more interest than short-term ones. On the right, you see an inverted yield curve. It slopes downward, indicating that short-term bonds now pay more than long-term bonds. This inversion is a rare event and is taken very seriously by economists and investors. It's a sign that the market expects trouble ahead. Historically, when the yield curve inverts, a recession often follows within 12 to 24 months. The bond market is essentially flashing a warning light telling us to prepare for economic turbulence. Let's look at some real-world examples. In 2006, the US yield curve inverted. Just 2 years later, the financial crisis hit in 2008. In 2019, it inverted again, and the pandemic recession followed in 2020. Most recently, in 2022, the yield curve inverted once more, sparking widespread concern among economists and investors. These examples show how closely the inverted yield curve is linked to upcoming recession. It's not a guarantee, but it's one of the strongest signals we have. If you see the yield curve invert, it's time to pay attention and start preparing for possible economic challenges. The bond market sends a message through an inverted yield curve. It's essentially saying that investors expect interest rates to fall in the near future. This expectation is usually tied to fears of an economic slowdown or recession. Investors flock to long-term bonds for safety, pushing their yields lower. Meanwhile, short-term rates stay high or even rise. This dynamic creates the inversion and signals that trouble may be on the horizon. Understanding this message can help you anticipate changes in the economy and adjust your financial strategy accordingly. Inverted yield curve isn't perfect, but its track record is impressive. Since 1955, it has predicted every US recession except for one false alarm. Economists and investors rely on it because it reflects real market fears and expectations. While no indicator can guarantee a recession, the inverted yield curve is widely respected for its reliability. If you're watching for early warning signs, this is one you can't afford to ignore. Next, let's move on to the second key indicator, unemployment claims. Employment claims are another powerful recession predictor. When people start losing their jobs, they file for unemployment benefits. A sudden spike in these claims is often one of the first signs that the economy is slowing down. Economists track weekly unemployment claims closely because they provide real-time insight into the job market. If claims start rising sharply, it's a signal that businesses are cutting back and the economy may be heading for trouble. Watching this indicator can help you spot economic weakness before it becomes headline news. The beauty of unemployment claims data is that it's updated weekly. This makes it one of the most timely economic indicators available. Unlike other data that might be released monthly or quarterly, weekly claims give you a near real-time look at what's happening in the job market. If you notice a consistent upward trend in claims, it's a strong signal that the economy is under stress. Economists and investors use this data to adjust their forecasts and strategies quickly. Staying informed about weekly claims can help you react faster to changing economic conditions. Tracking job market trends through unemployment claims can reveal underlying economic shifts. For example, during the early stages of a recession, claims often rise sharply as businesses lay off workers. Later, claims may stabilize or even fall as the economy adjusts. By monitoring these trends, you can gain valuable insight into the health of the job market and the broader economy. It's a simple but effective way to stay ahead of potential downturns and protect your financial interests. While unemployment claims are a valuable indicator, they're not foolproof. Sometimes claims can rise due to temporary factors like seasonal layoffs or natural disasters rather than a true economic slowdown. It's important to look at the bigger picture and combine this indicator with others for a more accurate forecast. By using multiple signals, you can reduce the risk of false alarms and make better decisions. Next, let's explore the third indicator, consumer confidence. Consumer confidence measures how optimistic or pessimistic people feel about the economy. When confidence is high, people are more likely to spend money, which drives economic growth. But when confidence falls, spending slows down and businesses start to struggle. Economists track consumer confidence through surveys that ask people about their expectations for the future. A sharp drop in confidence is often a sign that a recession is on the way. This indicator reflects the mood of the public and can signal trouble before it shows up in other data. Consumer confidence is measured through regular surveys conducted by organizations like the Conference Board and the University of Michigan. These surveys ask people about their current financial situation, their expectations for the future, and their willingness to make big purchases. The results are compiled into an index that tracks changes over time. If the index drops sharply, it's a warning sign that consumers are worried about the economy. This data is widely used by economists, investors, and policymakers to gauge the health of the economy. Consumer confidence directly affects spending patterns. When people feel secure about their jobs and finances, they're more likely to buy homes, cars, and other big-ticket items. But when confidence falls, spending slows down and businesses see fewer sales. This shift can trigger layoffs and further weaken the economy. By tracking consumer confidence, you can anticipate changes in spending and adjust your financial plans accordingly. It's a key piece of the recession puzzle. Consumer confidence is a useful indicator, but it's not always accurate. Sometimes people's feelings don't match reality, and confidence can be influenced by news headlines or political events. It's important to use this indicator alongside others for a more complete picture. By combining consumer confidence with unemployment claims and the yield curve, you can improve your ability to spot trouble early. Next, let's look at the fourth indicator, manufacturing activity. Manufacturing activity is a key driver of economic growth. When factories are busy and production is strong, the economy tends to grow. But when manufacturing slows down, it's often a sign that a recession is coming. Economists track manufacturing activity through surveys and reports like the Purchasing Managers' Index (PMI). A sharp decline in manufacturing signals that businesses are cutting back, demand is falling, and the economy may be heading for trouble. This indicator is especially important because manufacturing is closely linked to jobs and consumer spending. Purchasing Managers' Index, or PMI, is a widely used measure of manufacturing activity. It's based on surveys of business leaders who report on new orders, production levels, employment, and other factors. A PMI reading below 50 indicates that manufacturing is contracting, while a reading above 50 means it's expanding. Economists and investors watch PMI closely because it provides early warning of economic shift. If PMI falls sharply, it's a sign that trouble may be ahead. Tracking production trends in manufacturing can reveal important shifts in the economy. When factories ramp up production, it's a sign of strong demand and economic growth. But when production slows, it often signals that businesses are worried about the future. By monitoring manufacturing activity, you can spot early signs of trouble and adjust your financial plans. This indicator is especially valuable for investors and business owners who need to stay ahead of economic changes. Manufacturing activity is a valuable indicator, but it has limitations. Sometimes production slows due to temporary factors like supply chain disruptions or strikes rather than a true economic downturn. It's important to look at the bigger picture and combine this indicator with others for a more accurate forecast. By using multiple signals, you can reduce the risk of false alarms and make better decisions. Next, let's explore the fifth and final indicator, stock market performance. Stock market is often seen as a barometer of economic health. When stocks are rising, it's a sign that investors are optimistic about the future. But when stocks fall sharply, it can signal that trouble is on the way. Economists and investors track stock market performance closely because it reflects the collective mood of the market. A sustained decline in stock prices is often one of the first signs of an impending recession. By watching the stock market, you can spot changes in investor sentiment and prepare for economic shifts. Market sentiment is a powerful force in the economy. When investors are confident, they buy stocks and drive prices higher. But when fear takes hold, they sell stocks and prices fall. This shift in sentiment can trigger a downward spiral, leading to more selling and further declines. By tracking market sentiment, you can anticipate changes in the economy and adjust your investment strategy. It's a key indicator that reflects the collective psychology of investors. Volatility in the stock market is another important signal. When prices swing wildly, it's a sign that investors are uncertain about the future. High volatility often precedes recessions as fear and uncertainty drive rapid changes in stock prices. Economists and investors watch volatility indexes like the VIX to gauge market stress. If volatility rises sharply, it's a warning that trouble may be ahead. By monitoring volatility, you can stay ahead of economic shifts and protect your investments. Stock market performance is a valuable indicator, but it's not always reliable. Sometimes stocks fall for reasons unrelated to the economy, like geopolitical events or changes in interest rates. It's important to use this indicator alongside others for a more complete picture. By combining stock market performance with the yield curve, unemployment claims, consumer confidence, and manufacturing activity, you can improve your ability to spot trouble early. No single indicator can predict a recession perfectly, but by combining multiple signals, you can build a powerful early warning system. The inverted yield curve, unemployment claims, consumer confidence, manufacturing activity, and stock market performance each provide unique insights. Together, they help you spot trouble before it arrives and make smarter decisions. Professional economists and institutional investors use these indicators to stay ahead of economic shift. You can do the same by monitoring them regularly. You don't need expensive tools or subscriptions to monitor these indicators. Most are available for free online. For the yield curve, check the U.S. Treasury website. Unemployment claims are published weekly by the Department of Labor. Consumer confidence indexes are released by the Conference Board and University of Michigan. Manufacturing activity is tracked by the Institute for Supply Management. Stock market performance and volatility can be monitored through financial news sites and market data platforms. Staying informed is easier than ever. Now that you know where to find these indicators, it's time to put your knowledge into action. Set up alerts or bookmarks for the relevant websites. Check the data regularly and look for changes or trends. If you notice warning signs, consider adjusting your financial plans or investments. By staying proactive, you can protect yourself from economic downturns and make smarter decisions. Knowledge is power, and these indicators give you a valuable edge. Let's recap the 5 key indicators: the inverted yield curve, unemployment claims, consumer confidence, manufacturing activity, and stock market performance. Each provides a unique perspective on the economy and helps you spot trouble early. By monitoring these signals, you can stay ahead of recessions and protect your financial future. Remember, no indicator is perfect, but together they form a powerful early warning system. Early warning signals are crucial because they give you time to prepare. Whether you're an investor, a business owner, or just concerned about your job, knowing what's coming can help you make better decisions. By watching these indicators, you can adjust your investments, cut unnecessary expenses, and plan for potential challenges. Staying informed is the best way to protect yourself from economic shocks. Professional economists and institutional investors monitor these indicators obsessively. They use sophisticated models and tools to track changes and forecast economic shifts, but you don't need to be an expert to benefit from these signals. By learning to read the indicators yourself, you can make smarter decisions and stay ahead of the curve. The information is out there, you just need to know where to look. Most retail investors and ordinary people have never heard of these indicators, but by learning to monitor them, you gain a valuable advantage. You can spot trouble before it becomes headline news and make decisions that protect your financial future. Whether you're saving for retirement, buying a home, or running a business, these indicators can help you stay ahead of economic shifts. There are many misconceptions about economic indicators. Some people believe they're too complicated or only useful for experts. Others think they're unreliable or irrelevant. The truth is, anyone can learn to read these signals and use them to make better decisions. By understanding how the indicators work and what they mean, you can cut through the noise and focus on what matters. If you want to learn more about economic indicators, there are plenty of resources available. Government websites, financial news outlets, and educational platforms offer free guides and tutorials. By taking the time to educate yourself, you can become more confident in your ability to spot economic shifts and make smarter decisions. Knowledge is the best defense against uncertainty. Staying informed about economic indicators is easier than ever. With online tools and resources, you can track changes in real time and respond quickly to warning signs. By making it a habit to check the indicators regularly, you can stay ahead of economic shifts and protect your financial interests. It's a simple but powerful way to stay prepared. 5 indicators we've covered provide actionable insights that can help you make better decisions. Whether you're investing, saving, or planning for the future, these signals give you a valuable edge. By monitoring the indicators and responding to changes, you can stay ahead of recessions and protect your financial well-being. It's all about being proactive and staying informed. Recessions are a natural part of the economic cycle. They're not always avoidable, but early warning signals can help you minimize their impact. By understanding how the indicators work and what they mean, you can prepare for downturns and take steps to protect yourself. Economic cycles may be inevitable, but your response can make all the difference. Economic downturns can have a big impact on personal finances. Job losses, falling investments, and reduced spending can all create challenges. By monitoring the 5 indicators, you can anticipate changes and adjust your plans. Whether it's building an emergency fund, cutting expenses, or rebalancing your portfolio, staying informed helps you make smarter choices. Businesses can also benefit from monitoring economic indicators. By spotting early warning signs, companies can adjust their strategies, manage risks, and prepare for downturns. Whether it's cutting costs, diversifying products, or strengthening cash reserves, staying informed helps businesses survive and thrive during recessions. Long-term planning is essential for weathering economic storms. By monitoring the 5 indicators, you can make informed decisions about investments, savings, and career moves. Planning ahead gives you the flexibility to respond to changes and protect your financial future. It's all about being prepared and staying ahead of the curve. Economic indicators aren't just relevant in the US, they're used worldwide. Every country tracks its own yield curve, unemployment claims, consumer confidence, manufacturing activity, and stock market performance. By monitoring global indicators, you can spot international trends and prepare for global shifts. Staying informed about the world economy helps you make better decisions at home. Adapting to economic change is a key skill for investors, businesses, and individuals. By monitoring the 5 indicators, you can respond quickly to warning signs and adjust your plans. Whether it's shifting investments, changing jobs, or launching new products, staying informed helps you stay flexible and resilient. Building economic resilience starts with knowledge. By understanding and monitoring the 5 key indicators, you can prepare for downturns and minimize their impact. Whether you're an investor, a business owner, or just managing your personal finances, staying informed is the best way to stay strong during tough times. Sum up the 5 economic indicators we've discussed: yield curve, unemployment claims, consumer confidence, manufacturing activity, and stock market performance are powerful tools for predicting recessions. By monitoring these signals, you can stay ahead of economic shifts and protect your financial future. Remember, no indicator is perfect, but together they form a reliable early warning system. Now that you know the 5 key indicators, take the next step by setting up alerts and monitoring the data regularly. Stay proactive and adjust your plans as needed. By staying informed and prepared, you can protect yourself from economic downturns and make smarter decisions. The tools are out there, use them to your advantage. Economic recessions are challenging, but early warning signals can make all the difference. By learning to read the 5 indicators, you gain a valuable edge and can protect your financial future. Stay informed, stay proactive, and use the tools available to make smarter decisions. Thank you for watching, and remember, knowledge is your best defense against uncertainty. Staying ahead of economic shifts is possible when you know what to watch for. The 5 indicators we've covered are your early warning system. Monitor them regularly, respond to changes, and keep your financial plans flexible. With the right knowledge and tools, you can weather any storm and come out stronger on the other side.